A merchandising business sells goods to its customers and must buy those goods from another company. An important topic is how to manage the business's inventory, and we'll learn about the periodic and perpetual inventory management systems. Accountants must understand how to record purchases, returns and allowances, and discounts, which differ depending on what inventory system is used. Let's now look at inventory management systems. Merchandising companies like Max Out Sporting Goods purchase goods from other companies, such as manufacturers or wholesalers, in order to resell those goods to its customers. Merchandising companies use a system to manage their inventory, and there are really two types of inventory management systems: periodic and perpetual. Small businesses often use the periodic inventory management system. Like the name indicates, it means that inventory is only taken periodically, such as once a year, once a month, or more frequently. Outside of that inventory, the business doesn't really know exactly how much of a specific item it has on the shelves. If the business only sells a few items, it's easy to tell whether the inventory is low, but as the business grows, it becomes more and more difficult. That is why growing and large businesses use the perpetual inventory system, which tracks the inventory with every purchase and every sale and return. We'll learn first about the periodic inventory system and then about the perpetual inventory system. The purchase of merchandise for resale is a cost of doing business, and accountants use the purchase returns and allowances, purchase discounts, and freight in or transportation in accounts to track those purchases. The purchases account and the freight in accounts are expense accounts with a normal debit balance. The purchases returns and allowances and the purchase discounts are contra expense accounts with a normal credit balance. All of these accounts are part of cost of goods sold, the actual cost to the business of the merchandise sold to customers. One important topic is who pays for the freight charges. When you buy products from Amazon, you pay for the cost of shipping. In business terms, that is called free on board or FOB. That means the selling company will bring the goods to its loading dock, but from that point, the buyer pays all costs. From a legal perspective, it also means that from that point, the product belongs to the buyer. And if there's any damage en route to the buyer, it is the buyer's risk. There are circumstances, though, where the seller pays the freight charges up to the buyer's loading dock, and those terms are called FOB destination. Let's look at an invoice and see how those freight terms and other information is shown on that document. After all, accountants spend some time reviewing the invoices to determine how to properly record the business transaction. This is the invoice Max Out Sporting Goods received from Modern Sportsman for the purchase of men's compression t-shirts and shorts. At the top of the invoice is the name and address of the selling company, and in the upper right-hand corner is the invoice number. In the next section, we see the name and address of the buying company. In this case, the bill to and ship to address is the same. But for many companies, the billing and shipping address will be different. If Max Out had multiple locations, the invoice should be sent to the accounting location, not to the individual store. To the right of the buyer's name and address are the invoice date, the purchase order number, the shipping company used, which is Speedy Express, and the main payment terms of net 30 days. In the next section, we see the order number again. The salesperson field is not populated. The payment terms, the date shipped, which is a day before it was invoiced, the shipping company, and then we see FOB Tustin. Tustin is where Modern Sportsman is located. Next, we see the quantity ordered of 10, the description of the product, the unit price of $476, and then the total price. Since the shipping terms are FOB Tustin, The buyer pays for the freight of $360, which then brings the total to $5,120. So what does the accountant do next? Accountants record the invoice once the three-way match is performed. Do you recall what that is? That's right. The accountant matches the purchase order to the receiving document and the invoice. All agree the invoice can be recorded. Max Out Sporting Goods uses the periodic inventory system, which determines how accountants record the purchase. Under the periodic inventory system, all purchases are immediately recorded as an expense, and only after the inventory determines how much inventory is in stock or on the shelves will the accountant make an adjusting entry to move some of the cost to the balance sheet. Let's record the purchase now. We start by writing the date into the date columns and the account purchases into the description column. The cost of the shirts and shorts is recorded in the purchases account, and the shipping charges are recorded in the freight in account. That is why we debit the account purchases for $4,760. On the next line, then, we write freight into the description and debit that account for $360. On the third line, we slightly indent and write the accounts payable account into the description column and $5,120 into the credit column, since the payment terms are net 30 days. Then when the payment is due, we record a debit to the accounts payable and a credit to cash. This is the process for recording purchases for resale. When you purchase other goods that the business uses, like office supplies, office equipment, or software, basically goods not for resale, the freight charges are an integral part of the purchase and are not separated from the cost of the product.